connecting investors, financial institutions, and businesses around the world. Luxembourg is a center of excellence for global finance. Recognized for its unique international financial expertise, Luxembourg is solution-driven, stable, and open to innovation. A pioneer and global leader in sustainable finance, we help build a better tomorrow today. An international financial center and a European capital. Luxembourg is an exceptional and welcoming place to work and live. Discover what we can do for you.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning and welcome to today's Focus on Cross-Border Investments. Cross-border investing is of course part of the lifeblood of the global economy, directing capital to where it's needed most. But these are not mere financial exchanges, of course. These are ways of driving economic growth, they're channels for fostering sustainable development and sparking innovation. And for investors globally, those opportunities are a way to manage risk, they're a way to diversify portfolios, and of course generate exposure to new markets and new segments. It should be a symbiotic relationship and one that benefits both emerging and developed economies. At a time when global relations are somewhat frayed, the importance of efficient and effective cross-border investment cannot be overstated. But we are living and navigating an exceptionally complex set of circumstances, with geopolitical tension, with ongoing conflict and escalating trade disputes between major players. This is all affecting investment decision-making and, of course, capital flows. And to put things in perspective, UN Trade and Development showed that in their World Investment Report, 2023 saw global foreign direct investment, or FDI, fall by 10%. Europe, with $58.5 billion, captured a share of 1.2% of global inflows. So fairly sobering statistics. And what does all that mean for international investors and managers, particularly those that are eyeing Europe as an entry point? Well, that's the question that we'll explore this morning. We're going to start by looking at some of the remaining challenges in structuring funds for cross-border investment. Then we'll take the LP's perspective. We'll look at European private asset fund structuring, and then we'll end with a look at how cross-border M&A strategies are evolving in response to those geopolitical shifts, growing regulatory scrutiny, but also sectoral specific trends. I'm delighted to welcome our esteemed speakers this morning, and I'm going to start by handing over to Jullien Flores, who is Executive Vice President and Head of Global Government Affairs at the Managed Funds Association, for her keynote on unlocking potential and future pathways for international investors in the EU. Jullien, over to you.
Good morning. What a great day to be here with you all to discuss such an important and timely topic. I'm Jullien Flores, Head of Global Government Affairs at MFA, the trade association for the global alternative asset management industry. MFA's members manage over 3 trillion euro globally for institutional investors, including pensions and foundations across the EU. We're headquartered in Washington, D.C., but about half of our members have a presence in Europe, and MFA has offices in both Brussels and London, underscoring our commitment to the region, as well as our focus on cross-border investment issues. Luxembourg and the EU more broadly are important markets for MFA members, and alternative investment fund managers, or AIFMs, are beneficial to the region. AIFMs serve as an important source of capital to businesses of all sizes, strengthening capital markets and helping to drive economic growth. MFA members represent the largest and most globally active hedge funds, private credit funds, and other alternative investment managers. The industry's interest in the EU is high, and we see this as a really exciting time to reduce frictions on cross-border investments. Managers are excited about the potential for a more economically integrated bloc, as well as increased opportunities for harmonization with other jurisdictions. We're supportive of a reinvigorated capital markets union or savings and investment union, and we believe that rejuvenating the CMU initiative is pivotal in attracting more cross-border investment and capital to and investment in the EU. These efforts are essential for unlocking capital from managers in third countries, making EU capital markets more competitive and driving overall economic growth. There are opportunities to right-size or calibrate existing frameworks in order to spur more capital markets activity. Yet at the same time, there are risks that alternative asset managers, as part of so-called NBFI, could be subject to further and inappropriate regulation. And it would be misguided and harmful to EU growth to apply bank-like regulations to alternative asset managers. We believe a diversity of market participation boosts price discovery, reduces volatility, improves market efficiency, and provides an important source of capital to enterprises of all sizes. But to harness the power of deeper capital markets, several key reforms are needed, and I'd like to spend a minute overviewing a few of them. First, securitization. Policymakers should make reforms to the EU's securitization regulation and modernize the existing framework in order to relaunch Europe's securitization markets. The current framework is overly complex and disincentivizes EU investors and issuers alike from utilizing securitizations. This has reduced market participation and has also limited the effectiveness of securitization as a funding mechanism and a source of investment diversification for end users. We encourage policymakers to improve cross-border harmonization of these rules. This will enable managers to better diversify their portfolios, increase the EU's economic competitiveness, and attract more investors from within the EU and from third countries. Now let's turn to market structure. MFA is pleased to see EU co-legislators and subsequently ESMA make progress toward establishing a consolidated tape. Implementing a properly structured consolidated tape for various asset classes with reasonable commercial prices will enhance the efficiency, transparency, and competitiveness of the EU capital markets. Now we'll turn to short selling. Short selling regulations in the EU need to be recalibrated to strike a better balance between maintaining market integrity and ensuring market liquidity. The EU's short selling regulation would benefit from targeted reforms that would help encourage more capital and investment to flow into the EU 27. Two modifications in particular that we recommend include moving from an individual firm public disclosure of positions to an aggregated public disclosure of net short positions of shares outstanding, and streamlining short position reporting to reduce burdens and increase consistency across the national competent authorities. The current regulation is overly restrictive and discourages long and short activity. Recalibrating it, really just tinkering, will give investors more decision-useful information and at the same time incentivize more market participation and activity. Now let's talk green initiatives. As policymakers work to reinvigorate the CMU, of course, there's widespread interest in creating more opportunities for private capital to help finance sustainable and green initiatives at the EU and at member state levels. Alternative asset managers operate across diverse global financial markets, and this is why MFA has encouraged that EU policymakers have the potential to keep on interoperability and flexibility front of mind when continuing to fine-tune sustainable finance-related legislation and regulation. Broadly speaking, we support the objectives of the Sustainable Finance Disclosure Regulation, SFDR, in attracting private investment to support the transition to a sustainable, climate-neutral economy. But we suggest that policymakers reform where needed the existing framework rather than seek to potentially replace it wholesale. Overhauling the framework could heighten the risk for investor and market confusion. In addition, we believe that SFDR focuses overwhelmingly on sustainability and securities on the long side, but overlooks the role of other types of exposures. So accordingly, we encourage EU policymakers to adjust SFDR so that it better recognizes the role of tools like derivatives and short positions in further incentivizing companies toward more sustainable business practices. When considering reforms, policymakers should keep in mind the goals of improved market access for third country managers and enhanced international competition and diversity in the EU financial markets. Now, a subject nearly everyone is paying attention to in one form or fashion, and that's AI. The European Commission, in its ongoing public consultation on AI and financial services, is seeking to ensure that AI is used responsibly and ethically in the financial sector. However, it's important that any new regulations don't stifle innovation and limit the benefits of AI applications by being overly burdensome. MFA recognizes that advancements in technology, including AI, have benefited fund investors, and the technology has demonstrated the potential to unlock important efficiencies and yield benefits to end users. So we believe regulators should carefully consider whether prescriptive AI regulatory frameworks will hamper innovation and reduce cross-border investments. Given the recent entry into force of the EU's AI Act, with the implementation of numerous provisions taking place over the next few years, policymakers should consider perspectives from stakeholders and individual member states about the workability of the recent regulatory framework before proceeding with prescriptive financial services-oriented AI legislation. Now, a moment on risks, shifts, and headwinds. The role of non-banks, such as alternative asset managers, continues to grow throughout the global economy, and this is good. As a result, though, policymakers and regulators' focus on the scrutiny of non-banks has been increasing. There are important discussions on the use of leverage, counterparty risk, credit provision. However, much of the concern around the financial stability aspects is misplaced with respect to alternative asset managers. AFMs are integral market participants who are well regulated, including under the recently reviewed and updated Alternative Investment Fund Managers Directive, or AIFMD2, and who strengthen the EU capital markets and drive economic growth. MFA cautions against a regulatory overreach that seeks to treat AFMs as though they are banks. Another area for potential headwinds that we can discuss is just the broader geopolitical and electoral ecosystem. Predictable and stable regulatory frameworks are important to unlock full economic potential of the EU and its member states. Divergent policies between EU member states could create barriers for cross-border investments and complicate operations for international managers. Regulatory alignment across the EU will shepherd long-term business stability and make a premier investment destination. Evolving geopolitical dynamics in the EU and member states present risks, uncertainty, and opportunity. At the close of 2024, we will have seen over 2 billion voters elect leaders across the globe. The shifting political dynamics, policies, and transatlantic relations will require policymakers, regulators, and stakeholders to continue to maintain a regular and healthy dialogue in order to avoid disruptions to ongoing financial services policies and initiatives. MFA and our members look forward to welcoming new and returning lawmakers in the EU who will ultimately set the financial services agenda that impact key operational and business decisions. I can't underscore enough the importance on the focus of cross-border collaboration, coordination, and interoperability. It really is at the core of unlocking the potential of the EU and the Capital Markets Union. MFA is proud of the work our members do to enhance EU capital markets, provide credit, and generate returns for investors. To protect the diversity of participation across global markets, we'll continue to engage with policymakers on the best ways to create an environment that supports innovation, protects investors, and encourages cross-border flow. Critical to these efforts will be promoting a regulatory approach that acknowledges alternative asset management's unique role in global capital markets and creates consistent regulatory frameworks across the EU and its member states. In closing, I want to give a big thanks to Luxembourg for Finance for pulling together this tremendous event that is extremely timely and important. Would also like to thank other participants taking part today. And with that, I will turn it over to the next panel. Over to you, Catharine.
Thank you, Jullien. Good morning, everyone, and thank you for joining us today. We have a very insightful discussion ahead, and I'm thrilled to be moderating this panel on cross-border investment structuring, an area that is both complex and incredibly vital in today's global market. I'd like to start by introducing our great panelists who bring wealth of experience and expertise to this conversation. So first, it's my pleasure to introduce Miriam. Miriam is Executive Director at Waystone, based in New York, and with a robust background in European fund management. Miriam has extensive experience in the oversight and governance of funds, particularly in the alternative space. She has played a pivotal role in helping clients to navigate the complexities of cross-border fund structures with a strong focus on compliance and regulatory challenges. Her expertise is particularly relevant as we explore the evolving landscape of cross-border investments. Next, I'm delighted to introduce Abbas Suleiman. Abbas is a Senior Director and Head of Structured Finance at Ivesco Real Estate, and with over 2 decades of experience in the investment management industry, Abbas is a leading expert in structured finance, tax structuring, and fund accounting. At Ivesco, he oversees structured finance matters across various funds and jurisdictions, and including equity and debt structuring. His deep understanding of Luxembourg legal and financial frameworks, particularly in the context of tax neutrality and efficient fund structuring, makes him an invaluable voice in our discussion today. As for myself, I'm Catharine Pogorzelski. I'm a partner and the global co-chair of investment management at DLA Piper. My practice focuses on advising sponsors and investors on structuring, operating, and investing into private funds. With a legal background in both local and global markets, I'm passionate about finding practical and innovative solutions and connecting dots for our clients. So now, to briefly set the scene for today's discussion on cross-border investment structuring, I'd like to highlight why this topic is so relevant. Cross-border investments are essential in an increasingly globalized market, offering opportunity for diversification and access to new capital. However, they also bring significant complexity, and from navigating different regulatory environments to managing operational and tax challenges across multiple jurisdictions. Luxembourg's role in this landscape is particularly noteworthy, as it has become a central hub for managing cross-border funds. In 2023, Luxembourg accounted for 15% of all EU cross-border structuring activities. So this highlights how cross-border framework are driving growth and innovation in the investment management industry. Yet the global fund management is at a critical juncture, and with another wave of substantial regulatory change on the horizon, the industry is rapidly transforming in response to technological innovation, market shifts, fierce competition, and also the ongoing needs for cost optimization amid the scarcity of capital and talent. At the same time, barriers like gold plating and market entry hurdles are further complexifying the landscape. So for many managers, navigating this complexity has become a core part of their value proposition and requiring anticipation and strategic agility. So our discussion today will explore how these factors are influencing cross-border investment strategy and what it means for investors as they navigate this dynamic landscape. So if you allow me, Miriam, to start with you, considering your experience with European fund structures and also leveraging on your US nexus, what are the challenges sponsors are facing when it comes to positioning their fund structures for successful fundraising?
With pleasure, Catharine. So we had a great discussion on this during our prep sessions. As someone who has worked in both Ireland and Luxembourg and has spent the last number of years here in the US, that's allowed me to better understand some of the challenges that sponsors operating globally are facing today. I would say that the main challenge faced by many managers today lies in structuring to allow for the broadest possible investor base. As a GP, ideally, you want to present one cross-border structured chart to your prospective LPs and then allow them to choose their ideal entry point to access your strategy based upon their own domicile and indeed their tax preferences. The second challenge that sponsors face is they also want to future-proof their strategies. Therefore, they need their structures to be as efficient as possible. So their fund structure should be structurally and operationally flexible. They should minimize regulatory and operational burden. They should ensure investor protection and transparency and critically minimize cost and tax leakage. We spoke about on our prep sessions the differences between US managers and the challenges that they face when raising in Europe. And I would say the obvious one is the level of increased regulation, whether that be at the fund manager level or the product level, and then the resulting investor expectations that come with this increased regulation. I think it's very important to remember that here in the US, private funds are not directly regulated. And so speed to market is an important consideration when fundraising in Europe. I think that's one of the reasons, or one of the many reasons, that the SCSP has grown so popular with the US managers. The SCSP can, of course, benefit from the AFMD marketing passport by virtue of the appointment of a third-party AFM, but as we know, it does not have to go through the CSSF's regulatory approval process. Final point I would say is, in particular, when it comes to private credit managers, US managers and indeed their investors will often want A, a fund that operates like their current US or Cayman funds, B, a fund that blocks US taxes, so perhaps UBTI or ECI, which is essentially income realized from a US business and applies to loan origination, and C, a fund that is ideally tax-friendly in the US, the EU, the UK, and possibly Canada and Switzerland.
Yeah, no, that makes perfect sense, and that's what we hear as well. Thank you very much. Abbas, I think Miriam touched upon a few tax points and important elements on which I'd like to have you commenting as well. So given your experience and leveraging what you've done at Ivesco, what you still do at Ivesco, so what are the most effective strategies that we can use for mitigating tax and operational risks in cross-border investment structuring and making then that structure, you know, future-proof and efficient, resilient, as Miriam mentioned?
Thank you, Catherine. I would say essentially it's a two-pronged attack. So first of all, the tax function forms an integral part of the decision-making process, which therefore requires us to be proactive. I mean, for example, we sign off on every single IC paper and have a respective specialist on the IC board as well. We've also developed our tax code of conduct, which essentially sets out the way how we as a team operate and how we approach tax risk. Generally, we take a conservative approach. We try not to focus on the tax arbitrage. And essentially, our primary objective is to manage risk. So, for example, right now, we are currently undertaking a review of our substance. Now, just to be clear, that doesn't mean that we have bad substance. What we believe is that we can actually improve, we can make it better. Now, this actually also links in with current themes in regards to the focus that tax authorities have around substance as well. All this essentially translates into our structures being simple. Complexity can have a contagion effect where it starts to impact wider areas of the business and naturally starts increasing operating costs as well for our funds and eats into performance. The second prong of the attack is education. Now, you may be wondering, what exactly do I mean by this? What we want to ensure is that our non-tax colleagues have an awareness of what's happening out there, and we do this by publishing newsletters and videos. We've also been innovative in terms of the way how we communicate these themes. So, for example, we have videos which are animated, which I would call it Instagram length, to explain very, complex concepts such as withholding tax, but with a focus on simplicity.
Yeah, no, it makes it's very very relevant and so true. And I mean, whatever we see at the moment is that we usually advise clients to really look at the structures when deciding to set up a fund, to really look at the structure in a holistic way from top to bottom, so to ensure that every possible element are really right at where they should be at the start. So thank you, Abbas. So Miriam, if I may take you on a slightly different path. So sustainability and ESG is increasingly critical for LPs, and while approximately 1/3 of assets managed by sustainable funds in Europe are domiciled in Luxembourg, it's still notable that many players are finding the complexity of SFDR compliance extremely challenging. And so some of them have even been declassifying their funds from being an Article 9 to an Article 8. So how are you helping fund managers to navigate the complexity of SFDR? And what are the trends that you're currently seeing in response to the recent requirements?
Yeah, thanks, Catherine. I think, frankly, one of the biggest challenges that managers are facing globally is the increasing cost of regulatory compliance, whether that be in regards to ESG and SFDR or otherwise. Fund managers are facing increasing pressure to develop innovative products that cater to the diverse and growing demands of their investors. And this includes the need for customized solutions that align with specific client preferences, and in particular with regards to alternative asset classes like private equity and sustainable investments. I think the availability of data, and indeed good quality data, is one of the biggest challenges that we see our clients face today, in particular across our Manco and our fund administration business. Modern investors are seeking increased transparency, and that not only covers fund performance, but it also covers ethical operations and sustainable practices. Their demands are driving the need for data collection methodologies that not only provide actionable insights, but also adhere to ESG principles. So I think across the industry, we can continue to expect to see innovation around data collection in particular, and there are a number of industry players really leading the charge there. I think it would be remiss of me not to make a nod to the US, given that that's where I'm sitting and most of our clients are raising funds in Europe. Here in the US, the topic of ESG is very much polarized. There's a real challenge for global managers operating domestic funds and funds within the EU. So the SEC has been very steadily focused on enhancing ESG disclosures, beginning first with public companies and registered investment funds. And we do expect that shift to focus on private funds going forward. We do already have some rules like the names rule, but many investment firms operating funds in Europe are struggling because of some pressures here in the US. So at the end of July this year, US Congress sent a letter to over 130 investment firms. They had signed up to a Climate Action 100 initiative, and that was designed to combat climate change and hold companies accountable for their greenhouse gas emissions. But in that letter, it noted that Congress will now be reviewing these companies under antitrust legislation because they're seeing them as prioritizing woke left investments over their fiduciary duties. And so many of these investment firms operate Article 8 or Article 9 funds, and they're now faced with the challenge of withdrawing from the Article 8 or Article 9 category, or indeed withdrawing from this Climate Action 100 initiative. And that's a real challenge for global managers. So I think that's one of the biggest that they face.
Yeah. So if I hear you well, it's not only a matter of disclosure, but we are going further than that. So it's really transforming something that started as a disclosure into, creating, demonstrating tangible actions and impact. And so hopefully Luxembourg will be capable of leading the way in that space. Yeah. Thank you, Miriam. So, Abbas, if I may turn to you, there is another topic I'd like to pick up for this session, and so Luxembourg has been a pioneer in the structuring of alternative investment funds. This is known, and providing favourable environment with regulatory clarity, investor protection, quick implementation of AIFMD framework. But now with the introduction of LTIF 2.0, there is a significant push toward making alternative investments also accessible to retail investors. So how do you foresee this impacting your approach to fund structuring and making alternative investment strategy possibly accessible to retail investors? What are the main challenges also that you anticipate?
Thank you, Catherine. I mean, let me start off by saying that the LTIF 2.0 initiative is very much welcomed. However, operational challenges need to be overcome. Now, if we take a step back, when we say retail, in my simple mind, I make a distinction between those investors that meet the definition of well-informed and those that don't. Now, the current suite of Luxembourg vehicles already caters for the well-informed investors, and operationally you can build a similar operating model for these investors to what you have for existing institutional investors. I mean, we've seen strategic partnerships being developed with private wealth banks who already have this capital base on their books, and in essence, this is an entry point for organizations to get a taste of retail. It's essentially a halfway house. For now, I think we're in a holding pattern where we need to work through the operational conundrum, which comes with launching the LTIF. Needless to say, technology may help to bridge this gap. However, that being said, we have seen examples where an LTIF could be used to originate debt in France. Now, given that lending is a regulated activity in France, this could be an interesting proposition. However, I do fear this may not be the spirit in which the regulator meant the LTIF for, if that makes sense.
Yeah, no, true. Though, I mean, that is clear in the LTIF regulation that indeed they are also meant to kind of facilitate loan origination activities, and was seen as a way to kind of facilitate also the deployment of the capital into the real economy. So still pretty much aligned. And also, I think what's interesting also is that, you know, going into the retail space is still something that might still evolve, and we still don't know exactly what are the terms of, you know, admitting retail investors into the structures and how that will look like. And Miriam, if I may, I think during the preparatory discussion we had, you've mentioned also interesting facts around ETF and how, you know, the position of Luxembourg shifting into that space could evolve.
Yeah, of course. I think there's a huge part for Luxembourg and Europe in general to play in the adoption of ETFs. If we look at the buyers of ETFs, so in Europe, it's primarily 80% institutional. The opposite is true here in the US, where it's almost 80% retail. So there's a huge market demand for ETFs. I think ETFs and indeed the LTIF have the potential to play quite a pivotal role in response to the aging population and certain gaps in the pension funds. And while historically Ireland has been dominating the ETF space, Luxembourg is certainly catching up. Just last week, we saw the launch of Europe's first ever CLO ETF. So there's a large opportunity for Luxembourg, which has always been agile and very able to quickly adapt to market demand. So I do see that as a focus on the horizon for the Luxembourg market.
Great, looks good. Thank you. Thank you very much. So I think we arrive at the end of this session today. So very briefly to wrap up, so it's clear that indeed cross-border investment structuring continues to evolve rapidly, driven by both regulatory development and also market forces. So from the growing emphasis on ESG impact to the complexity of tax structuring and operational resilience, these trends underscore the need for strategic agility and forward-thinking solution, so to make structure future-proof and efficient, as you both mentioned. So we've explored how Luxembourg is uniquely positioned to help navigate these challenges and also provide stable yet innovative environment for fund managers and investors alike. So Miriam, Abbas, thank you very, very much for sharing this invaluable insight today. And thank you to our audience for your engagement. We hope you found this discussion useful and that provided you with actionable insights to navigate the increasingly complex investment management environment. Thank you very much. And now I hand over to Nadia. Thank you.
Thank you very much, Catherine. So hello, everyone. My name is Nadia Bonnet. I am a private fund lawyer at Simpson Tatcher here in New York City. I am a Luxembourg qualified lawyer and I started my career in Europe. My current clients are all US-based fund managers who either want to access or have already accessed the EU investor and investment markets. Frank, would you mind introducing yourself?
Sure, Nadia. So I'm the resident fund partner here in our New York City office. We basically assist US fund managers with their capital raising efforts in Europe through Luxembourg structures. And we can also help them when they deploy that capital in Europe.
Great. So let's start with a very general but a key question. Frank, why do US GPs often prefer setting up vehicles in Europe when raising EU capital as opposed to using offshore jurisdictions?
Okay, there is not one single reason for that. There's several reasons for that. I think the first reason is investors need to be confident on the strategy they invest in, but they also need to be confident on the legal structures they commit to. And Luxembourg simply has a great reputation there. So that's one of the drivers for Luxembourg. European investors also quite like it if a structure is subject to EU regulation. It's again a matter of credibility. And maybe the third reason is investors want to be familiar with the products they commit to, right? So we have the crown jewel in Luxembourg, the special limited partnership, and that basically answers to all their needs. It answers to their push for familiarity, because similar structures are also offered to by other jurisdictions, for example. So I think it's fair to conclude that Luxembourg basically offers the tools and has also the reputation, and that basically drives the push from EU investors to Luxembourg. It's simple as that.
Okay, I see. Let's focus on those managers raising EU capital. Why don't they rely on Delaware or Cayman vehicle, for example?
It's a very fair question, and my answer is basically along the same lines. Some jurisdictions outside the EU were blacklisted at some point by European authorities, and that's very damaging for their reputation. It can impact their ability, it can impact investors' ability to commit capital and the GP's ability to raise capital through blacklisted entities. And Luxembourg basically has a clean sheet there. It never had any blacklisting issues. And public perception also plays a very important role. I think it's fair to say that investment structures to European investment platforms just do better when it comes to public perception, as they comply with sophisticated EU regulation. And don't underestimate the force of the public perception. It's especially key when, for example, pension plan investors are involved.
Okay, so it is actually European investors who seem to be asking US managers to collect EU money using European-based vehicles. But is there also a benefit for the US manager to do that?
Yeah, there's a hard push from European investors for European platforms to be used by these US managers. But I also think there's an important benefit for the US managers themselves to rely on such European platforms. And the key benefit there is the passporting rights. So if a US manager uses a EU investment platform and registers that platform with one single EU regulator, it can basically distribute that platform all over Europe to professional investors. So you just need one registration. And I think seamless access to the EU investor market is something vehicles outside the EU can simply not offer. So again, it is basically very simple. Like for any business, you need to have access to your potential clients, and EU structures give that seamless access to those clients, being the potential investors.
Okay, thank you. So is there a minimum investment volume required to make setting up in Europe economically viable for the US manager?
Okay, that's a good question. We have to deviate there between two aspects, whether it's a legal minimum and whether it's an economic viability minimum. There is no legal minimum. You can raise $1 through a European structure, you can raise billions through a European structure. The question is, however, is it worth to set up the structure in Europe, right? The benefits have to outweigh the cost. And I think it's fair to say that you actually need 50 to 100 million in your structure to make sure that those benefits do outweigh those costs. So again, there's no legal minimum, but an economic viability minimum is around 50 to 100 million, I would say.
Okay, thank you, Frank. That's very helpful. So how do US managers test if they can raise enough money before committing to the cost of setting up such a fund?
Yeah, we had some legal changes there over the year. I would say a decade ago, it was arguably required to set up the structure in Europe first before you could test the waters with European investors. And that could be an expensive affair because you have to launch the structure. You have to put an army of lawyers to work, right? And then you discover, perhaps, that you cannot sell the structure to investors. Nowadays, that is different. We have pre-marketing in Europe. So basically what you do, you go out to investors with draft fund documents, and you can test investor appetite with that. You don't need a legal structure for that. If you encounter sufficient investor appetite, you can launch the structure. To be able to talk to each and any investor in Europe, any professional investor in Europe, what you could do is you reach out to a service provider in Luxembourg, a regulated service provider. You sign an agreement with them, and they can front your pre-marketing efforts and give access to all those professional investors all over Europe. And that's a very nice tool that we have nowadays. Because in today's challenging fundraising environment, you don't want to set up a structure you cannot sell. So you first test the waters through pre-marketing, and if it all works out, you set up a structure. So that's how they do it.
Very well, okay. And so are there any specific challenges US managers have when they set up in Europe?
I wouldn't call it challenges. I would say there are some attention points. The three key attention points are opening bank accounts, that's one. Complying with AML rules, anti-money laundering rules in Europe. And managing the funds through a host AFIM, a white label manager as we call it. So let's focus on those three aspects. First of all, the bank accounts. In principle, if you need to launch a fund in Luxembourg, you set up a GP entity, a general partner in Luxembourg. And to launch that entity, you arguably need a bank account. And that can take a while in Luxembourg because banks show less appetite to open those accounts, and their diligence procedures are pretty strict, right? So it may even delay the fund launch in a worst case scenario. However, we see nowadays that there are more and more products coming to the market to avoid that you need a bank account or that you can launch such a bank account in a very efficient way. The next one is the AML rules. US asset managers are sometimes a bit shocked if they see what you need in terms of European AML if you want to launch a fund. First, the fund manager needs to onboard it by the service providers in Luxembourg. The service provider will impose an AML process on the US manager. And when the fund exists, the AML process is also conducted on the investors that come in. And the third aspect is, if you buy assets, you also need to run AML on this. And that can be quite overwhelming for US managers. However, we have seen that the US will also introduce similar rules, similar AML rules in 2026. And I expect that that will basically close the big gap we currently have between European AML and US AML. So that's definitely going to help. I think what US managers should also realize is that AML rules are sometimes a bit difficult to handle, but they also very much contribute to the credibility of the fund structure. And they are one of the reasons that European investors are so keen to commit to European fund structures, because they know that all the other investors in the fund structure are credible because they have to go through the same AML process. Last point is relying on host or white label managers in Europe. If US managers want to have access to European investors, it can set up an own European manager, but that's a pretty burdensome and expensive affair. So we see that the mid-market managers don't choose that route. Only the very big sponsors use that. Instead, they hire European fund manager, white label manager, or host AFM as we call it. And these host AFMs have to be involved in the fund management process. So the US manager and the Luxembourg host manager, they have to operate basically as a team. And that typically needs some hand-holding in the beginning. So it's important that when the fund is launched, they sit down, they work out the marketing process, they work out the investment process and the risk management process, and operate going forward as a team. And that's something that needs attention in the early stages of the fund launch already.
Okay, thank you for this very insightful explanation, Frank. I've also heard concerns about tax rules that might apply to these funds, especially the reverse hybrid rules. Can you explain how these impact European fund structures?
Yes, I'm happy to do that. So I think we should all understand that the reverse hybrid rules can potentially tax a fund entity. What we should also understand is that these rules were introduced to combat tax planning by multinationals, not by funds. However, funds are also in scope of the rules. The good news is, however, that the rules hardly ever cause a tax drag at fund level. Conditions that you should meet to be impacted by the rules are designed for multinationals and not for funds, and therefore funds are often not impacted by the rules. So the rules do exist. We have to check when investors come in whether they apply or not. But I would say in the vast majority of all the cases, the rules do not apply, but they have to be monitored.
Good, yeah. On our side at STB, we have also found that while our clients are aware of these rules, they rarely encounter issues in practice. So moving forward, what would you say is the latest trend in European fund structures?
Okay, yeah, the latest trend, I think it's very obvious. It's democratization of or retailization of the private markets, right? So what that actually means is that private fund managers, managers of private funds which invest in illiquid assets, try to seek pockets of capital that are with private wealth investors. And traditionally, those managers don't have access to such pockets of capital because EU regulation largely says that private strategies, private investment strategies are only accessible for institutional investors and not for retail investors. However, we now see that the industry is trying to find a balance between the offering of the private equity industry and the needs of retail investors and the preferences of retail investors. Because retail investors also know about the attractive returns of private equity, and they also seek access to that. And Luxembourg is very well positioned there. So Luxembourg tries to introduce regulatory regimes that basically match the needs of the private equity managers and the preferences of retail investors. And there are some products entering the market. We have seen the Luxembourg Usage Part 2 regime, for example, which is basically a regulatory wrapper that combines the needs of retail investors and the preferences of the private equity industry. And recently, we have also seen the ELTIF, the European Long-Term Investment Funds, which even offers a passporting regime for certain investment strategies. So it's very easy with those products to access European retail investors or retail investors that are based beyond Europe. And this is a very hot topic among fund lawyers and also drives a lot of innovation because fund managers are traditionally used to just a number of LPs, let's say 50 to 100. And if they want to onboard retail investors, the number of LPs really explodes, and that needs to be handled. And therefore, we see a big drive when it comes to innovation for onboarding and investor reporting, because fund managers suddenly have to answer to the needs of very large pools of investors, while they're not used to that for their traditional strategies.
I see. Well, thank you for that. Any closing remarks on how Europe can contribute to attract international fund managers?
Yeah, I genuinely believe that the EU legal framework strikes a very good balance between regulation and flexibility. And obviously, there's always room for improvements. But let's not focus on that improvement so much, because I think the European financial centers did a great job already there. I think the focus should now be on maintaining the high quality legislation and to make sure that the regulatory developments keep pace with the market needs. And then I especially refer to the retailization trends.
Thank you, Frank. I think that's a great note to end on. So thank you for everyone for listening in. Thank you to Luxembourg for Finance for organizing this insightful and very topical event. So now we hand the floor to Robert White for the next and last session on cross-border M&A in Europe. Enjoy the rest of the event.
Thank you very much, Nadia. I appreciate the introduction. So my name is Robert White. I'm the market leader for EY in Luxembourg, where I also have the pleasure of leading our wealth and asset management assurance practice across EMEA. And I have the pleasure of being joined here today by Dr. Marcus Peter. Marcus leads the investment funds and private equity practice of GSK Stockman in Luxembourg. Of course, Marcus is an expert in investment funds law and M&A law, particularly as it pertains to Luxembourg, and is a member of a series of industry associations. So it comes as no surprise to anybody, cross-border investment is a key aspect of modern financial markets and a very necessary social and economic tool, moving finance from areas where it's most available to areas where it is indeed most needed. And of course, we hope, allowing good ideas and good businesses to flourish, providing liquidity to our financial markets, and ultimately allowing savers and investors the ability to secure their long-term financial well-being. Now, we are in a particularly interesting situation currently. We have interest rates higher than recent historical positions. We have challenges in valuation. We have a range of geopolitical topics on the agenda currently. So many of these do contribute to what is a challenging picture currently. There were hopes at the advent of 2024 that we would see a surge in cross-border M&A activity. We have had some anomalies and exceptions, but generally the increase in activity has been somewhat moderate. Some industries have benefited to a greater extent than others. But all of this presents a challenge, and we believe that Luxembourg has a range of solutions to offer to some of these challenges. But before we go into this detail in any greater granularity, Marcus, can you provide me with an overview of the current M&A landscape in Europe as you see it? What are the current mega trends we see? How would you describe deal volumes? And what are you currently observing?
Yeah, thank you, Robert. I think I fully agree with 2 points which you mentioned. We have challenging times. And at the beginning of 24, we had expected that we have a bit of a better M&A development as opposed to 23. So if we look a bit at the figures, if we look at deal volumes, first half 23, first half 24, we can say for Europe that we have seen a modest increase. So I personally find that's really good, because if you look at the mood everywhere in some countries, it's not the best mood to do M&A transactions, but here that was very good, that we move up and not down. Whilst if we look at the deal number went slightly down. So I think we went from 370 or 80 down to 350 in Europe, which is a sign that there is maybe a bit less appetite for the deals, but a bit more appetite also for higher volumes. So that gives me a bit of an optimistic outlook also for 24. And when it comes to industry sectors, the two leading sectors were technology, and also energy. So these two elements, if you look at statistics, by far they have been part of the most important deals we have seen in Europe. Country-wise, it's interesting. France, Germany go down. I don't know if it's linked to political instability or landscape. And for example, countries like Spain or Sweden, they have seen partly a quite stark increase in M&A activities. Also Czech Republic, but I think that might be linked to one or two specific deals with a higher volume. Yeah.
And it's an interesting landscape, isn't it? Why? Because whilst everything you've just said is true, one could certainly argue that we have an unprecedented amount of pent-up pressure in that there are massive amounts of supply, particularly for large private equity managers who have reached the end of their hold period on certain projects. And at the same time, we have unprecedented amount of demand in that there are a number of, again, financial institutes or indeed corporates who are looking to place their money. How do you reconcile that with the picture we've just painted? And where does the release come, in your view?
That's a good question. Yeah, I mean, I can reckon at least that people they want to do the deals. Yeah, as you said, supply demand is there. We have the private equity funds, few of them which have come to the end of the lifetime. They need to have exits, which are difficult or which can be done only at a lower value. But then we have people who have the money. They need to invest it. So I think it's important to bring them back together, and the most important element is confidence. They need to have confidence on both sides that they can trust each other again, that they can find a good price, that they can maybe also find the leverage to do the deal, which, as you mentioned before, with the bit higher interest rates might also be complicated in the equation. So that's an important element. Confidence, and then these people need to be brought together. Absolutely. And then we have hopefully a good release, maybe already now in the next 2 or 3 months. Let's see, but I hope at least in the beginning of 25. Huh?
And of course, a key aspect to that will be the regulatory landscape. You know, that's an inevitable piece of the puzzle. Could you offer a few words on what do you see as the recent relevant EU regulatory developments as they pertain to cross-border M&A?
Yes, correct. I mean, with you to the legal framework, good news for these two sides. There is relatively stability. So we have, of course, the EU merger control, where we haven't seen big amendments recently. So this is something which the people can rely on. But of course, we have the foreign direct investment control, which is still enacted by each of the member state countries themselves. And here we have seen in the last 2 years a little bit of more difficult provisions coming up, which might block or at least make deals more complicated. Remembering just for Germany, where we've seen that there were 1 or 2 deals a bit put on hold by the politicians. So this is a bit difficult and maybe also a consequence of the economic developments in those countries. This is 2 points. A third one is a little bit of a new element. It's a foreign subsidy directive. This is a new element from last year, where the European Commission looks at companies who want to do cross-border mergers into Europe. They look at subsidies. Did the company receive any subsidies recently from a foreign government? And was this subsidy maybe distracting a bit the fair trade or the fair competition? So this should be looked into by the players who want to do the M&A transaction. And the last point is, which is not yet set into law or stone in Europe, it's so-called outbound screening. Yeah, so we've seen that recently in the US. Joe Biden, he has recently enacted an order ordering American companies who want to invest abroad via M&A transactions, that there's a screening, where do they want to invest into? And this is to avoid that they invest into companies where they bring maybe their own US technology or financial means to countries which are politically at the moment considered as a bit of complicated for US politics. Huh? So this is something which might swap into Europe, but not yet. It hasn't
so
appeared
there's
yet.
certainly factors there which investors need to inform themselves of. Right. Now, we mentioned at the outset, despite the fact the markets have been somewhat muted, there have been bright spots. You know, you mentioned tech, one could mention oil and gas, financial services, leisure. We have seen significant amounts of inbound investment from Chinese investors. What has provoked this in your view, and how has the EU reacted to this?
Yeah, I would say there has been interest, growing interest again, because as we all know, last year and also a bit already 22, China inbound investments into Europe have declined quite starkly. So there has been problems, as we know, with the economy in China a little bit, but also with certain orders from the Chinese government to be more careful when investing into US or European countries. Now, I must say, at the end of 23 and beginning of 24, at least we have seen again a new interest. So more inquiries about targets here in Europe. We've seen recently, I've seen an acquisition in France of a real estate asset management company. We have seen also here in Luxembourg recently a sale of a bank by a Chinese investor. So there is more activity coming. At least I can sense it from the questions which we receive from Chinese enterprises. And politically, they also have received in China the order from the government to be a bit more, how do you say that, propelling those investments forward, going abroad again. Yeah.
No, thank you very much. And so I think despite everything we've discussed, and undoubtedly there are a series of challenges, one certainly gets the sense that there's cause to be optimistic. You know, we have unprecedented amounts of built-up demand, unprecedented amount of built-up supply, and it seems to be the case that there's an ecosystem there ready to facilitate the release of that pressure. With that in mind, why, in your view, do investors choose Luxembourg to structure their cross-border M&A activity? What are the key qualities that they find attractive?
Yeah, I think, when talking to these potential M&A acquisition entities in different countries, Sweden or even China now, what they are looking for is stability. That's the first element, stability in the political system, but also in the financial system of the country. They don't want to invest through or into a country which in 1 year's time has political issues or maybe is downgraded by the rating agencies. So here we have this stability in Luxembourg. We've had it for many years. And we had elections recently, which now also seem to have brought a new government, which seems to do stable business. So this is what they appreciate. And then the second point is that when they do this deal into Europe, they're looking for kind of a platform through which they can structure the deal. And the Luxembourgish corporate law environment is very suitable for this, because also first, it didn't change a lot. And secondly, the rules are comparatively easy to understand and to enact as opposed to other countries. German lawyer by origin, so I know a bit the German corporate law, which is quite complicated. So these are the two main elements. And then, of course, if also the money can flow precisely and swiftly into Luxembourg target or to the seller or to a seller in another country, if this also works well with the people who do the job here on the ground, who even speak sometimes the languages of the people who want to buy, this is something which they appreciate and which
I think that's a very valid point. You know, there is undoubtedly a highly developed ecosystem, and I find that there is a recognition that cross-border investment is key, and there's an established path to do these transactions. But that is very, very helpful. I hope that if we come back here in 12 months' time, we're talking about higher levels of activity, et cetera, et cetera. Do you have any predictions for that?
Well, I have the prediction at least that the deal volume will go up again also in the second half of 24. And then for 25, it's difficult to look ahead. But I would say we are at least on a better track than 1 year ago. Yeah, there's more confidence in the market now. And also M&A transactions, they help also economies to grow. We should not forget this as well. Yeah.
Wonderful. Well, with that, I think we can conclude. Marcus, thank you very, very much for your comments. And I'm happy to hand over to Simon. Thank you.
Thank you, Robert. Well, a new dynamic is certainly upon us in terms of cross-border investing, shaped by macroeconomic and geopolitical change, but also regulatory and fiscal. At the same time, growth in interest in private assets and retailization and technological advancement are reshaping the investment landscape. We've heard this morning about how those trends are impacting decision makers and how those decision makers are looking at weighing the relative value proposition of jurisdictions and vehicles. And as we enter the final months of the year, of course, we'll see what 2024 gave us in terms of cross-border investing. So at this point, I'd like to thank our sponsors for this morning. I'd also like to thank you, the viewer, for tuning in. And do join us next time for our next online event, which will be our inaugural Digital Finance Forum, and that's on October the 15th. Until then.